exclusively for civil engineering students?
Yeah, it's for civil engineering students. Yep. We've got kind of a busy couple of days ahead, and I wanted to just review all of that with you. On Friday, our class meeting will be a recorded lecture video. We won't meet together live. There's no attendance requirement for that. You should watch the recording. And one of the reasons why it's especially important that you watch it carefully is that I'm going to be introducing the project, which is worth a substantial part of your course grade in that recorded video. So I'm going to be giving you the main idea of the project and showing some basics on how to do the calculations for it. So it's really important. And then homework 5, which has just been posted, is due on Monday. It has 4 problems. I think they're relatively quicker compared to this last assignment you just finished. And in addition to that, I also provide you the final answer for each of the 4 problems. So you'll have a pretty good idea of whether you're on the right track with those. Then in class on Monday, we've got exam 1. We've just got 50 minutes for that exam. I've talked a little bit about it in the past, and the reminder is that you can bring a sheet, letter-sized, front and back, with any kind of notes or equations or guidance that you'd like to see on there. And you should also bring your laptop computer, because there's going to be a question that I'll ask you to solve using Microsoft Excel. So does anybody have any questions related to the announcements? All right. Today we're going to continue with the in-class exercise we didn't finalize in class on Monday. We're going to solve that capital recovery problem and then talk about a couple of related ideas having to do with permanent investments and capitalized costs. And then I'm going to introduce how to price bonds, which is an important part of the course that we'll have a couple of times, and today's the first time you're going to be seeing some of the ideas having to do with bonds. All right, so just to review, what I told you last time is that capital recovery is an annualized calculation that takes into consideration both the purchase price and the salvage value. So if you think about the cash flow diagram that I showed you before, the purchase is an outflow, so the arrow was pointing down. And the salvage or market resale is an up arrow, so it's money that you're getting. So they're in opposite directions, and capital recovery is the difference between the two when you annualize them. So to calculate it, you would find the annual equivalent of the initial purchase price, and then you'd subtract out the annualized equivalent of the lump sum future value, which is the salvage or resale price that you're getting at the end of the useful life. And so the minus sign is just because you want to find out how much additional revenue is required to cover the cost of the equipment, and those purchase price and salvage values in opposite direction. So that's what we will do for this last question, which was on in-class exercise 12. If you've got that handy, get it out. Otherwise, you can just go from what's on screen there. We're purchasing a truck that's $85,000, and then in 6 years, we'll sell it for $18,500. So our given interest rate's 8%. Here's the 8% factor table. And we want to know what's the capital recovery amount for that equipment. So what it means you're going to have to do is take the lump sum present value, find the annual equivalent of it, then find the annual equivalent of this salvage value, which is in year 6, and the difference between the two. So I'll give you a couple moments for those calculations, then I'll bring the solution up on the screen, and we'll talk about this, this additional question that's below. So the capital recovery is the equal and opposite amount to the cost of ownership. And so sometimes the problems will ask, like what is the annual equivalent of owning the equipment, and sometimes it'll be phrased in terms of how much additional revenue do you need to make to justify the equipment. And so whether the capital recovery amount is negative or positive really just depends on the context of the question, but it's really the magnitude of the capital recovery that is the most important. And so here in this case, we're paying $85,000 and receiving $18,500 in year 6. We want to know what's the annual equivalent of that. So here I set it up where I said, you've got $85,000 worth of outflows that we want to annualize. And then here in the brackets, I've got find A given P, 8%, N equals 6. So the factor for that's 0.21632. And then the 18,500, which is the salvage value, that's positive. Multiply it by its factor for find A given F. So the annualized equivalent of that cost of ownership is $15,865. And so then how much do you have to earn to account for that? It would be positive $15,865. So this is the annual equivalent of the costs, subtracting out the salvage value, and then the revenue needed would be the equal and opposite amount. All right, so that's capital recovery. The next part of the in-class exercise, it just asks a separate question unrelated to that truck. And I think I added on this question because there's something related to it in the homework. So let's say that your company spent $85 million to build a bridge that's going to last forever. And if the interest rate that it borrowed the money to build the bridge is 4.7%, then what's the capital recovery? So in this one, if it lasts forever, there's no salvage value. But we're trying to annualize something that goes on to infinity. So 1, 2, 3, 4, and so on through forever. And we want to know if you're spending $85 million, then what is the annual equivalent of that if it goes on forever? And it's actually pretty simple. The annual amount is just the present value multiplied by the interest rate. So how much you would have to earn each year to justify that would be the $85 million multiplied by the interest rate of 4.7%. So it works out to $3,995,000. All right, so that's a perpetual investment. So, whether they are getting the revenue through a toll on the bridge, or if it's going to have to be paid from a general tax fund or fuel taxes, whatever the case may be, if the applicable interest rate's 4.7%, then you need to earn 4.7% of the initial investment every year to justify that. And the interesting thing is that after 100 years, that future revenue is going to be negligible. So the vast majority of the value is recovered in the early years because of the effective inflation and the time value of money. 100 or 200 years in the future, this $3.9 million that you're receiving as revenue isn't very valuable anymore. The reality of the situation is that there would probably also be operating costs. If you're going to be building a bridge, you need to repave it occasionally, you need to repaint it occasionally. So even bridges that have a really long lifetime, like the Brooklyn Bridge or the Golden Gate Bridge, they still have ongoing operating costs. And so they're going to be increasing the tolls that they charge over time, not only to pay for the lump sum construction costs, but also those ongoing maintenance expenses as well. But This is something you'll need to know for the homework. One other idea, which is very closely related, is how much money could you receive each year if you put $100,000 into the bank and the account is 4%, how much could you withdraw every year indefinitely? So it's the same concept here. It's just we rearrange the equation. Well, actually, no, we don't rearrange the equation. It's just a calculation of income that you're receiving. So it is 4% of the initial amount is how much you could withdraw perpetually without ever exhausting it. Because at the end of each year, if you're earning 4% of the principal, then that means at the end of the first year you have $104,000. So you could withdraw $4,000, and then the next year you're earning 4% of the same $100,000. And so you just have the principal preserved, and the withdrawal that you're taking is just the interest component of it. All right, now let's go on to talking about bonds. Oh, actually, got some more stuff here. This is an illustration of a time value of money table that if you look at the column of A/P, it's showing as the number of years extends on to 100, then this is the 4% table. It's showing that the annual equivalent is approaching 4%. If you have an infinite number of years, then it does become 4%. So the longer it is that you are taking the withdrawals, the closer it is to just being the interest rate that you can withdraw perpetually and not exhaust the principal. So capitalized cost is taking the reverse of that and saying how much could you afford to spend now if you had a guaranteed stream of revenue in the future. So if somebody was going to promise to give you $50,000 a year forever, how much is that worth today as a lump sum? We just rearrange this equation and solve for P by taking into account the interest rate. So this happens occasionally with lotteries where you can either take a lump sum payout or they'll spread out the lottery payments over generally 20 years. So if they say that you've won $20 million in the lottery, the way they usually structure it is they give you $1 million now and then $1 million every year for the next 20 years. So they can say you're getting $20 million, but it's actually much more affordable for them than if they gave you a lump sum payout of $20 million now. So sometimes lottery winners who are really impatient to get as much of the money as possible will get an accelerated payment, and so they take a lump sum that's much less than the stated payout over time would be. So this is how you'd calculate what the lump sum equivalent of an annual series is you just simply divide the annual series by some interest rate, and then that would be able to tell you the capitalized cost of it. So if you want to withdraw $50,000 a year forever from an account that earns 10% interest, then you should deposit $500,000 into that account, because it's the amount that you want to withdraw each year, $50,000, divided by 0.1. So that's $500,000 that needs to be deposited today. And there are a lot of public sector projects that are actually very expensive to build, and we consider them as permanent. So here's a picture of the Brooklyn Bridge, but dams like the Hoover Dam or Glen Canyon Dam are very often constructed as permanent investments. Canals like the Panama Canal or Suez Canal, they're going to be around forever. And so if we want to know the annual worth of those, then we simply multiply the initial construction cost by the interest rate that applies, and then that's how you'd recover it on an annual basis over time. All right, so now we're going to talk about bonds, and I've been buying a lot of bonds recently. I have a very pessimistic view of our economy right now, so I've been selling almost all of my stock holdings in the my retirement account and in my personal brokerage account. I just think that there are a lot of things that can and will go wrong in the economy, and bonds are a more stable way of preserving your assets. So it's important to understand how to price bonds and how things like yield on bonds works. So that's what we're going to be talking about today. A bond is an interest-bearing certificate that is a way for companies or governments to raise revenue. And so the U.S. government, for example, is spending, I think, $5 trillion a year, and it's only getting something like $3.5 trillion a year in tax revenue. And so they have to finance the rest. Or, a local government that wants to build a new football stadium will very often sell bonds to the public so that they can get the money today, but pay it back over time. So when you buy a bond, what you are buying is an agreed upon rate of interest, and what you get for giving them a lump sum payment now is generally it's structured so that you get a series of interest payments over time, and then you get some lump sum redemption in the future. So here's a screenshot I took. This looks like it was actually maybe 2 years ago when bond rates were higher than they are now. More recently, I just bought some bonds yesterday and they're paying 4%. I bought 3-month treasuries, and the yield rate on those was 4% because interest rates have come down a little bit since I took this screenshot. But what it shows is that the duration of the bond has an impact on the interest rate that they pay, and then the creditworthiness of the bonds also has an impact. And so AAA rated bonds are deemed to be more creditworthy and more secure of an investment. So if you look at, for example, the 10-year yield on corporates that are AAA rated, the 10-year yield is 4.67. But if you're willing to buy companies' bonds that are more risky and just have a single A credit rating, then you can earn 6.15% interest. So the safer it is, the lower the interest rate that gets paid, and the more risky it is, you're being compensated for that risk with a higher interest rate. So there are a couple of trends we can see in the pricing data. One is just that the longer the bond term, generally the lower the interest rate. Although things have been really confused and unsettled recently, there's something that's called an inverted yield curve where right now the way that the bond pricing is that intermediate duration bonds are priced lower than short-term and long-term bonds. So the two components of how you get your money back when you buy a bond are the interest payments that you receive periodically over time, and then a lump sum payment which represents generally the return of your principal. There are all sorts of exceptions to this. There are some bonds that only pay a lump sum at the end, and there are some bonds that pay less than the face value at the end or more than the face value at the end. But most commonly, bonds are structured so that you get periodic interest payments, generally quarterly, and then you get a lump sum return of principal at the end. And so the amount of the interest payments is R, which is the stated interest rate of the bond, multiplied by Z, which is the face value of the bond. And then the lump sum that you get at the end of the bond's life, we give that the variable C. So here's an equation that allows you to find out what the value of a bond is now. So its current face value of the bond. So you should already be familiar with what we're seeing in the parentheses here. So find P given F, that's saying the value of the bond now takes into account that lump sum payment that you're getting in the future. So C is a lump sum payment in the future. So if you want to know how much the bond is worth today, discount it. And the rate that you discount it at, I, is the yield rate per period. There's two different interest rates that apply with a bond. One is the stated face value interest rate, which is what the bond issuer is paying as interest. But the value of bonds is constantly fluctuating. due to economic conditions and the creditworthiness of the company that issued the bonds. And so the yield rate is very often different from the bond rate itself. So R is the bond rate, and that stays the same. But the yield rate varies due to economic conditions and the creditworthiness of the company. So the two components of value of a bond is the present value of the redemption price and the present value of the interest payments. And so for the interest payments, what this is saying is the amount of the interest payment is R times Z. R is the rate, Z is the face value of the bond. And so if it's a 4% bond and the if it's a 4% bond and the face value is $100, then the interest payments would be $4 per year. Of course, bonds sometimes pay out quarterly, sometimes they pay out annually, sometimes it's every 6 months. And so N doesn't necessarily represent the number of years, it just represents the number of periods until redemption. So I know this is a lot to take in all at once, and we're going to get some practice with some examples on how to price bonds. But does anybody have questions so far about bonds in general or about this equation?
What happens when the U.S. government defaults in the 2030s?
Well, I don't know that there's a risk of the U.S. government defaulting for two reasons. You know I'm a pessimist. I've already said I'm a pessimist. But I don't think the U.S. government will default because, number one, they have the right to tax the population. And so if they need money, they'll just take the money that they need. And they also have the right to devalue the U.S. dollar. And so they could just print more dollars and pay their debts with the dollars that they've printed. And that would be bad for us, but it would be a way for them to technically satisfy their debt obligation. So I don't think that they're going to go through a technical default, but I still do think there's plenty of bad things that could happen, like higher taxes or high inflation. All right, well, let's do this example. Let me give you a copy of our in-class exercise. Okay, so I'd like you to fill in the blanks. You know, read through the statement here. The definition is provided for each of them. And then just substitute into the formula and so the two different interest rates, in bold it's saying per period. So, for example, the yield rate is quoted as 8% per year, but if it's paid semi-annually, that means twice per year, then the yield per period is 4%. And that's why I've given you the 4% table. And then the bond rate per period, if the annual rate is 6%, the bond rate per period is 3%. Okay, so if it is semi-annual compounding and it's 10-year bond, that means that there are 20 periods before redemption. And this assumes that we're buying the bond when it's a new issue, so that all 20 of those periods to redemption are ahead of us. It is possible that you can buy a bond after it's issued on the secondary market, and then in that case N would be different. But here it's 20 periods, and if the bond pays 6% per year, but you want to get a yield of 8% per year, what that means is you're going to have to pay less than the face value of the bond. If you want your yield to be higher than what the bond issuer themselves is paying, then that means you can't spend $1,000 on it and expect to get a higher yield than the interest rate that the bond issuer is paying. So the bond rate per period is 3%, yield rate per period is 4%, and in this case, the face value and redemption price are the same. So it is redeemable at the face value. That tells you that they're the same. So the calculations are that we've got two components of value. There's the return of principal, which has a value of $456. There is the present value of the stream of interest payments over time, which $407. And so added together, that means that this bond has a value of $864.10 if you're trying to achieve an 8% yield on a bond that's only paying 6% per year. So that's what you should pay for it. Anybody have questions about this one? So I just pulled up my son's college savings account, and I thought I'd show you, like if you were going to buy a bond today, this is what the screen looks like. This is, it's sorted right now by yield to maturity. And so I clicked on 3-month bonds. And so these are bonds you can see in the search criteria that have a maturity between December of this year and January of next year. And so U.S. Treasury bills are similar to bonds. It's just the duration is shorter. Bills are durations that are less than a year. Treasury notes are 1 year to, I think, 3 years. And then Treasury bonds are anything longer than that. So these are T-bills, but it's the same as bonds. And these are zero coupon bonds, which means it's such a short duration, they don't bother paying you periodic interest. It's just you recapture all the value of your investment by purchasing at a discount. So like, for example, if you were going to buy $25,000 worth of bonds, then you'd pay $24,754 now, and then on December 18th, they'd deposit $25,000 into your account. So you're buying it at a discount to what it's going to pay out when it matures. All right, so the second problem in this in-class exercise, let me pull that up as well. It suggests that maybe it would be easier for us to solve this one using Excel. So we're going to do a demo with Microsoft Excel for calculating the bond calculations on problem 2 and 3. So you wish to invest in bonds that have a face value of $100 if the bond rate is 6.7% per year nominal. So that means, remember the difference between effective and nominal? That means without compounding taking into account. So bond interest payments are paid twice per year. So that means that the bond rate per period is going to be this nominal amount divided by 2. In 25 years, the bonds are redeemable for $200. So this is an example where the face value is different from the redemption price. So Z and C are different in this problem. So if you're willing to accept a yield rate of 5% per year, how much should you pay to purchase the bond? So let's just summarize like the variables that were identified in the previous example. So these same different definitions apply. Let me copy these. We can go through it together. So N, the number of periods before redemption. 25 years paid twice per year, so N is 50. 50. The bond rate per period is the 0.065 divided by 2. So the bond rate per period is 0.0325. Okay, the yield rate per period, we want a yield of 5% per year, nominal. So 0.05 divided by 2 is 0.025 per period. And then the redemption price, C, is $100. No, sorry, 200. It's redeemed at 200. but the face value is 100. So the question is, how much should we pay in this case? So the face value, the bond rate pays 6.5%, but we're willing to accept a 5% yield per year. And that can sometimes be the case. Like if this bond was issued during an environment where interest rates were higher and then interest rates fall, then a bond that was originally issued at a really high interest rate is going to become more valuable than its initial purchase price. So this is going to be a case where we find that the purchase price we ought to pay is higher than the initial face value of $100. Okay, so how could we solve this one with Excel? Let's do that together. Just going to take a screenshot of this and paste it in so we've got it handy as we're working. All right. So N is 50, number of periods before redemption. R, which is the bond rate per period, 0.0325. I, which is the yield rate per period, is 0.025. C, which is the redemption price, is 200. Z, the face value, is 100. And let's just define all these terms to the side of it so we've got it. Number of periods until redemption. Bond rate per period. Okay, so what is R times Z? R times Z is the amount of interest that you get each period that it's paid. So the interest amount each period. So R times Z, that means that every 6 months, this is going to pay out $3.25. So it's 6.5% per year nominal. So that means $3.25 of interest comes to you every 6 months. All right. Well, what is the PV of the interest payments? Okay, so if we get $3.25, let's just amend this to remind ourselves, we get how many of these? We get 50 of these payments. $3.25 is going to be paid out to us 50 times. So let's do the PV function. Equals PV, where the rate that we're going to use is going to be the yield rate. So click here on the yield rate. The NPER is the number of periods. And now this R times Z, it's going to go into the payment field. You know, normally we skip over the payment field and we put individual lump sum amounts into the FV field. But this is a recurring payment where the same amount comes to us over and over and over. So I'm going to put that in. It's the minus of this payment amount to find the present value of it. So what this is saying is that $3.25 paid out every 6 months for 25 years has a present value of $92.18. This is the PV of the interest payments when discounting at the yield rate, I. So then the PV of the redemption price is the second component of it. So this is $200 that we get 50 periods in the future. So discount the FV from 50 periods in the future at the yield rate I. All right. So equals PV at our yield rate, 50 periods. This time we're skipping over the payment field because it's a lump sum. The return of principal, we put it into the FV, so the negative of that redemption price, and it finds the lump sum value today in the present. And so then the total value of the bond now is the sum of those two components. It is the interest payments plus the return of principal. So this is the value of the bond now. $150 is how much we ought to pay for the bond today. And that's problem 2. Any questions about that? All right. I've just got a couple of minutes to demonstrate this last one. So let me bring that up. I'm going to bring it up here since I've already got it pasted in. All right. So let's consider the setup that's given in the problem 3. It says that the bond pays $55 4 times per year for 10 years. So N is 40 because it's quarterly payments for 10 years. We don't know R. That's not defined. But we do know R times Z. That's the amount of interest that gets paid every time. So it's $55 that's getting paid each time. So we're going to go straight to R times Z. But the bond rate per period isn't explicitly defined. We do know that we're trying to solve for the yield. So I've shaded that just to illustrate that that is going to be an unknown that we're solving for. The redemption price is $1,000, and that is what gets paid out in 40 periods. We also don't have the face value given, but we don't need it because all we need to find the PV of the interest payments is knowing that the interest payment is $55 per year. So we have to start off with a guess for the yield. Let's say maybe we start off of a guess is 1%. So then we're going to set up the PV of the redemption price using that 1% yield rate. So equals PV, where the rate is this guess of the yield rate. NPER is the number of periods. And then this is talking about the redemption price, so that goes into the future value field. So if it's 1% yield, then 1,000 in the future is the same as 671 now. We'll do the similar calculation for the PV of the interest payments using this guess of the yield and 40 years minus of the given $55 each time. So then the total is the sum of redemption price and the interest payments. And now here's what we have to do. It says that the bond price is $900. We're going to have to change the interest rate until the present value of the bond equals what we know is 900. So 2% gets us closer, 3% gets us closer, 4% gets us closer. So what we could do instead of iterating is goal seek. Data, what if analysis, goal seek, and our goal is for this sum of the value to be equal to $900, which is the known bond price, and we'll have it change the yield, and this is how you calculate yield. So when I was showing you on the Charles Schwab website how the yield to maturity is calculated, that's just done automatically because they know what the price of the bond is. So if you know the price of the bond, you can back calculate the yield from that by knowing the interest amounts over time. All right, it's 1:50, out of time. Remember, class on Friday is a recording, then we've got our exam on Monday. I'll see you then.